Good morning. Thank you for joining us. My name is Travis Bradford. I am the Director of the Energy and Environment Concentration here at the School of International and Public Affairs at Columbia University, and faculty affiliate for the Center on Global Energy Policy, our world-class center on emerging and innovative issues in the energy system and energy policy. The center and I are both delighted to welcome you to today's presentation of the International Energy Agency's Renewable Energy Medium-Term Market Report that was issued this month by the IEA. We have two of the co-authors here to talk about the report, and I think you'll see why we're so excited about this, because this is a fairly exciting time to be exploring the dynamic growth and even some of the limits and constraints that the emerging renewable energy technologies are facing. Before we get into that, I want to give a couple of business notes. We're going to see the presentation, and then we're going to do some questions and answers. And toward the end of that, we're going to have audience questions and answers, including those of you who may be watching online. Are welcome to, or even those of you in the room, can use your devices and text or tweet us at Columbia U Energy with your questions, and hashtag CGEP events. So we would love to hear those, and we'll try to include as many of those in the presentation as possible. A couple of upcoming events which I think you should be aware of before we get into this one. Next Monday, October 26th, we have two events coming up which people should check into if they're of interest. One is at 12:30 here at SIPA, Gauging the Impact of Russian Sanctions with Louise Skyner and Richard Nephew, a very important and timely topic. And later that evening, over at the Faculty House, we have a conversation with Jim Rogers, former CEO of Duke Energy, on his new book, Lighting the World, which focuses on providing energy access to people all over the world. And Jim is a fascinating thinker on these topics, and it is obviously a great topic. One event coming up, which I think everybody should join, because there's something in it for everyone, is 2 weeks from yesterday and today. We have our 11th annual Columbia University Student Energy Symposium, and this year it's bigger and more ways to engage than ever before. In addition to the general conference, which we'll have on Friday the 6th, with a number of fabulous keynote speakers, and panels that include faculty and outside experts. We also have the day before, we have a venture competition for emerging ventures in the space, a case competition for student teams from around the country to come that's sponsored by Booz Allen Hamilton Energy Practice, and we have a career fair for students who may want to meet with a number of employers. And you should certainly check out, if any of that sounds interesting, and I'm sure there's something on there that is, you should check out the website at cuenergysymposium.com. and see what all the events are. It's important that you do that quickly, because a number of registration deadlines, particularly for things around the case competition and the career fair, are coming up over the weekend or next Monday. So I would encourage you to do that immediately and join us on November 5th and 6th. Finally, on November 12th, also over at the Faculty House nearby, David Crane, CEO and President of NRG, promises to be a great and interesting conversation, given some of the his strong views and a deep knowledge of this sector. So those are things coming up with the Center on Global Energy Policy, and hope to see you there. As I said, I'm really excited about this report, because in a former life, and still currently, I run something called the Prometheus Institute for Sustainable Development outside of my academic responsibilities. And the Institute has done a number of things, including a lot of market research on renewable energy. So I think that this is the most interesting topic, and I voted with my feet to say so. And I've, in that time, I've published a lot of market research reports on various parts of the renewable supply chain around the world. And But in terms of getting the most up-to-date the information about how this is going, I think the IEA really is the authoritative source to kind of aggregate this stuff and has visibility to what's going on around the world across all of the sectors and countries. And so I think this is a good way to kind of get a sense about how and where this transformation is happening. And as you'll see from the presentation, the authors refer to this as a profound shift. And given we have to re-rate for a number of things, these are very thoughtful people, and when they use words like profound, you should take that seriously. They don't use those types of words casually. So Michael Waldron is an energy market analyst at the IEA Renewable Energy Division. In addition to his work on this report, he's also done work in oil and biofuels, and prior was at Lehman doing energy market analytics as well. Heymi Bahar, working on this report, obviously has experience in renewable energy, and previously worked at the OECD and at the World Bank and worked on issues outside of energy, including an issue that I think is very important, which is arsenic in water in Bangladesh. It's one of these tragedies that I'm glad that someone like Heymi has spent some time working on. They're both graduates of SICE at Johns Hopkins University, so well trained, and they both live in Paris now at the IEA working on these reports. So with that, I'm going to let them walk through their presentation, and then we'll follow up with some questions and answers after that. So I think if you'll help me welcome Michael Waldron and Heymi Bahar. Thank you.
Okay, thank you very much for the introduction. We're very happy to be here, being back in New York. We presented this report also 2 years ago, so we're trying to get back every so often and disseminate our findings. So the Medium-Term Renewable Energy Market Report was published on October 2nd. We launched it at the G20 Energy Ministerial in Istanbul, where there was a focus on renewable energy and how to scale up renewable energy through improved domestic policies and coordinated financing actions. So we kind of shaped some of the messages around this report to cater to that launch. Maybe, okay. Or I'll just stand farther away, actually. So the name of the report is a long acronym, so we call it Mr. as short, so don't confuse that with any other cultural references as I go through the presentation. The report fits in very nicely with a lot of the work that the IEA does on renewables. And the report is a 5-year forecast. So we're trying to predict what we think will happen in the renewable energy markets over the next 5 years. We try to identify the major drivers and challenges to development in the electricity sector, in the biofuels for transport sector, and in the renewable heating sector. A lot of the slides in this presentation will focus on the electricity sector, but of course we'll also talk about the other sectors as well. In the electricity sector, we try to present 2 forecasts. So we present a main case forecast, which is basically what we think will happen given current circumstances and policies, et cetera. And then an accelerated forecast where we try to say, okay, what could renewable deployment be like if certain policies were changed or enhanced across a number of key countries. So this is market analysis the IEA does on renewables. This fits into the IEA's longer term scenario analysis, which you're probably familiar with, the World Energy Outlook, energy technology perspectives, tracking clean energy progress. So our forecast gives a good benchmark to how we're doing in terms of meeting the long-term scenario goals. At the IEA, we also have a work stream on grid and system integration of variable renewables, as well as technology analysis in the form of roadmaps. And sort of across everything we do, markets, integration, and technology, there's all sorts of policy analysis and policy recommendations inherent in all those things. So getting to the substance of the report, yes, it is a time of very profound change in energy markets, particularly when you're looking at the decarbonization or the cleaning up of energy markets. What we saw in 2014 was the first signs that economic growth have started to decouple from CO2 emissions. So basically economic growth rising, but CO2 emissions kind of leveling off. This is a result of multiple factors. Energy efficiency, I would point to almost first and foremost. Things like vehicle fuel economy standards in the US. coal to gas switching in the power sector, particularly in the US, but also the increased role of renewables in a number of countries around the world. Nevertheless, there are some concerns we have from the macroeconomic front. So oil prices have fallen precipitously over the past year. Gas prices have also fallen across a number of regions due to the supply and demand dynamics in the gas markets and regional gas markets. Of course, gas prices in the US have been at lows for multiple years, but they seem to be even lower this year. And it's likely they will probably stay low going forward, given what we're hearing about the amount of new gas supply coming online over the next 5 years. At the same time, we see evidence of economies slowing that had once been growing very robustly. So economies like China, like Brazil, which have been driving global demand growth. China's electricity demand growth is actually quite weak this year. And we see evidence as well that the OECD countries are still not growing as fast as they once did before the financial crisis. So overall, the economic picture is a bit more moderate. At the same time, there's the prospect of interest rates to rise in the US with monetary policy. Renewable development has occurred to date, or at least in the past 5 years, in an environment of very low interest rates, actually, which has made financing rather favorable, all things being equal. But what happens if interest rates start rising? How does this impact the renewable investment environment? Nevertheless, despite all these concerns, we see the overarching policy drivers. So these are the policy drivers which motivate countries to have renewable policy frameworks. We see these as being robust, and we put them into basically 3 different buckets. One is related to energy security and diversification of fuel sources. Another is related to local pollution concerns. So countries like as China, India, which have very high air pollution in cities, want to basically clean them up. And also the larger decarbonization aims related to not just decarbonization at the country level, but at the global level as well, in support of climate change objectives. As a result, because of these drivers, we're seeing that renewables are important in the pledges being made ahead of COP21. So to date, the INDCs account for about 90% of global CO2 emissions, and about 40% of the INDCs have some sort of feature related to a renewable target, a renewable goal, or renewables are treated somehow in the INDCs. So renewables are actually a key pillar of achieving not just the local goals related to energy security, but really achieving the COP21 related climate goals. As a result, in our longer term scenario analysis, we see renewables becoming the first source for electricity, so around 2030. When I say the first source, I mean that renewables are generating more electricity than coal, which is actually a pretty big statement, considering that I think about now, coal is about double that of renewables in terms of generation. So very big changes underway in the power sector and the role of renewables going forward. In the past, we had actually seen renewables starting to take a pretty sizable chunk of net additions to new power capacity. So what I mean by net additions, I mean taking the entire additions to the power sector and then accounting for retirements. So it's basically saying, okay, this is the new capacity coming online. In 2014, renewables deployed at a record level. So they deployed 130 gigawatts. This was almost 50% of the global additions to power capacity. And this is consistent with what we'd seen in the previous 5 to 6 year period, with non-hydro renewables increasingly taking a larger share. Going forward, we observe 2 pretty interesting trends. The first is that the additions needed in the power sector actually decline. So the difference between the previous period and the period going forward, that sort of delta right there, that's about the size of India's power system, basically. So less power capacity needed over the medium term because of some of the factors I talked about on the first slide related to energy efficiency, but also economic factors as well. What's striking is that renewables take up 2/3 of new power capacity going forward, which is basically the first time that they're occupying such a large share of new power net additions. Hydropower accounts for a portion of this, of course, but what is most striking is that non-hydro sources, so things like solar, wind, geothermal, bioenergy, are accounting for about 50% of the new additions to capacity. So this is clearly a step change in the way the power sector is evolving on a global basis. Now, if you put this in generation terms, and you tried to benchmark it against where we need to go to meet climate change objectives, you get a couple trends. So in the past decade, we've had very strong momentum in terms of renewable generation growth. Hydropower has always been a mainstay of this. That's the dark blue in the columns right there. But as you see, non-hydro sources have continued to scale up over time. And in 2013, renewables accounted for about 22% of global generation. Going forward in our forecast in this report, we see renewables accounting for over a quarter, so about 26% of generation. But nevertheless, if you benchmark this against what is needed to meet climate change objectives, and I'll define climate change objectives according to the IEA's 2-degree scenario. The IEA's 2-degree scenario basically puts together what is the energy system we need to have a 50% probability of having a 2-degree change in Celsius, 2-degree Celsius change in global temperatures over this century. What you need is of course, a lot of energy efficiency, first of all, to reduce the sort of the carbon intensity of the power sector. But you also need a lot of renewables as well. So you can see renewables need to account for more than a third of total power generation in 2025 to be consistent with those objectives. Going out to 2050, renewables need to be around 2/3 to 3/4, depending on the scenario and depending on how other technologies perform. But what is really striking is that the growth rate here needs to go from this kind of flattish line here to a much more sort of exponential growth. And this is not what we're seeing in our forecast right now. So renewables are still falling short. Even our forecast is basically consistent with what's in the INDCs in terms of the growth rates. So the INDCs, our forecast, are still falling short of what's needed to meet global climate change objectives. Now, that's looking at the renewable electricity sector, which of course is the fastest growing and the most robust in terms of renewable penetration. But what's going on in the other sectors? So renewable heat is a sector which is challenging to analyze. Its heating applications tend to be much more decentralized. They tend to be more complex in nature. They tend to be more fragmented. Heating applications in industry tend to be more bespoke. And in residencies, you have harder times doing things like basic things like metering and being able to monitor and form policy for a sector which is not as centralized as that for renewable electricity. Of course, things like district heating are a way to centralize heat. But in general, the policy frameworks for renewable heat that we've seen have not been as robust as that for renewable electricity because of the inherent problems or the inherent challenges in forming policy in the heating sector. Where we have seen progress mostly is in Europe, where some countries have adopted renewable heating schemes, are using things like building obligations or even capital subsidies or even subsidies related to heat generation, actually. And then in a number of developing countries and emerging markets, which have schemes for solar water heaters, basically, to provide domestic water heating, which is actually quite successful. But nevertheless, the growth rate that we see is for renewable heat is much slower than that for renewable electricity. The same goes for biofuels and road transport. So the large part of biofuels and road transport to date is conventional ethanol. So corn ethanol in the US, sugarcane ethanol in Brazil, ethanol also produced in Europe, as well as some biodiesel being produced. There are a number of structural challenges to scaling this up over the medium term. There's also a cyclical challenge related to the low oil price environment. At the IEA, we believe that conventional biofuels need to shift towards something we call advanced biofuels, which is basically biofuels based on non-edible foodstuffs. So in our longer term scenario analysis, and I don't show it here, you actually need a significant amount of advanced biofuels by 2025 to be in line, again, with our climate change objectives. We're not seeing this yet. Advanced biofuels have shown some progress in the past year and a half with the commercialization of some plants. But again, the policy schemes, the policy support schemes are not as widespread as we see in renewable electricity, and the penetration of renewables in the transport sector still remains relatively low. The same goes for electric vehicles as well. Although we don't define them as renewables, the transport sector remains a very difficult one to decarbonize. So going back to the electricity sector, I've given you kind of the overarching drivers for why renewables are attractive, why they're increasingly taking a larger portion of power sector additions, Let's get a bit more specific and look at the actual economics. And one thing which is very striking has been the decrease in renewable costs that we've seen over the past few years and what we see going forward. Now, renewable sources such as hydropower, such as geothermal, some bioenergy applications have been largely competitive versus fossil fuel alternatives for quite some time, actually. What is new is that we're seeing technologies such as onshore wind and solar PV actually improving vastly in terms of their comparability and economic attractiveness versus fossil fuel alternatives. So from and these show you modeled generation costs that we base our forecast on, and what they've done historically in terms of a global weighted average and what we think they'll do over the next 5 years. Onshore wind costs have decreased by about a third from 2010 to 2015. We expect another 10% decrease by 2020. Solar PV has decreased by 2/3. We expect another quarter decrease by 2020. But some technologies remain still relatively expensive. So offshore wind costs actually went up from 2010 to 2015 because projects move farther offshore, it's more complex, also challenges related to financing. But nevertheless, we expect costs to continue to come down from 2015 to 2020. So what are the reasons for these cost decreases? Well, I would point to basically 3 major factors. The first is sustained technology progress. So for example, improved efficiency in solar modules, reduced manufacturing costs for these things. Another would be the spread out of deployment to newer markets with better resources. So a lot of the locus of renewable activity to date had been in Europe. Heymi will show you a chart which shows the spike in terms of European deployment. And Europe, of course, has great wind resources. Some countries have good solar resources. Some don't have good solar resources. But nevertheless, deployment is spreading out to other markets with much better resources. And this actually gives you the opportunity to bring generation costs down even lower when you take those markets into account. And the third factor I would point towards would be improved financing conditions, which I'll describe the conditions, the enabling framework for that on the next slide. What this leads us to conclude is that for solar PV and onshore wind, you don't need high levels of incentives to actually deploy these technologies in a number of places around the world. But policies still really matter, particularly the market framework and the policy framework and the market design under which technologies compete. And when you have this appropriate market design in place, this appropriate policy framework in place, and you combine this with other things, such as good resources in newer markets, you actually get quite low generation costs that we're seeing now being contracted in places around the world. So the previous slide showed you modeled costs. These are actually contracted prices that we're seeing in the market right now. So this actually validates what we're saying on the previous slide in terms of what we expect in the next few years to get built. These are projects which should come online in the next 4 years. You see the variation. You see the markets. A lot of them are actually emerging markets, which have a combination of things. They offer long-term contracts. Renewables are capital-intensive assets, so it's very important to have some sort of certainty or some sort of visibility over the remuneration of the asset over its lifetime. This is often supported by a bidding mechanism or auction mechanism, something which introduces some sort of price competition between developers for these long-term contracts. Good resources, and I would also add that the presence of even limited financial de-risking measures can actually help quite a bit to reduce costs and reduce risks. So the participation of some concessional financing or public financing in some of these cases has been important to achieving these costs. So I would point to 2 in particular, one in Egypt and one in Dubai. These are actually sort of world lows for both onshore wind and solar PV. These prices on this map represent right now the best cases. So not everywhere in the world has these kind of prices. In Japan, you're not going to find these kind of prices right now. In other places around the world, you won't because of certain domestic factors. But nevertheless, they show what is possible over the next few years, and they show that a step change has been achieved in terms of costs. It leads us to conclude that in these kind of dynamic markets, you can build new onshore wind for something between $60 to $80 a megawatt hour, and new solar PV, utility scale, for something like $80 to $100 per megawatt hour. Now, what does that mean in terms of comparability to alternatives? It starts a bit complicated, but what it shows you is if you took that $60 to $80 benchmark range for onshore wind, and you say, okay, what are the gas prices you would need in order to build a new gas generation plant under certain running and efficiency assumptions. Would this be comparable with the $60 to $80 range for onshore wind? And as we've seen in the past, gas prices exhibit significant volatility on a regional basis. This is looking at the US, Europe, and Asian LNG prices. And what we see is that this significant volatility historically would actually be quite comparable to a $60 to $80 range for onshore wind, particularly in Europe and the Asian markets, not necessarily in the US markets where gas prices have been low for quite some time. And even with the fall we've seen in gas prices, it's also still comparable to this range we see for onshore wind. So we like to say that the costs for new onshore wind are increasingly comparable to the cost for a new gas plant in a number of locations. Now, I have to qualify this analysis by saying this does not mean that onshore wind or solar PV, for that matter, are necessarily competitive in any given circumstances or in any given markets versus gas. For doing a larger competitiveness analysis, you would have to look not just at the levelized costs of these things, but you'd need to look at the value of the electricity being generated, so when and where it's being generated. Of course, wind and PV are generated according to the subject to the resource availability. At the same time, you need to look at the power system itself and the flexibility needs needed for that power system to integrate higher shares of variable renewables. So you can actually improve the value of renewables by transforming the power system and making it more flexible, but there are costs associated with this as well. At the same time, there are costs on the fossil fuel side that are also not being taken into account. So this doesn't include carbon pricing at all. And as well, fossil fuels exhibit significant volatility. So even though what we're hearing is that there's a lot of gas in the world and that an era of cheap gas may be lasting for a while, there's still a cost in terms of volatility, and there's still a benefit that fixed cost renewables can provide in terms of hedging against that fossil fuel volatility, which is not taken into account. So wrapping up my portion of the presentation, I would just say, by and large, we think that now you can get more renewables into the system for less money. This is the capacity growth that we see over the medium term, and that's the investment that we see compared to the prior period with renewable capacity going up and investment going down. PV and wind account for about 2/3 of this, so it speaks to the increased role that these technologies are playing, and this is largely due to the fact that they're now more cost-effective and more affordable than ever. So now I'll turn it over to Heymi, who's going to give more technology and market detail.
Thank you very much. So we basically quickly go through where is this growth is going to come. So we basically see a major trend that the capacity growth of renewables are shifting from OECD countries to non-OECD countries. So we will see more capacity coming online in markets where there are emerging economies or developing economies. So, but let's go back to Europe a little bit and OECD countries. The reason why OECD country expansion, renewable expansion is slow is basically there are two basic trends that we observe. The first one is that we see the economic growth situation going down, and then we see less power demand needs coming in Europe. So that's the first reason. The second reason, we see some uncertainty over the policy structures that are implemented in Europe, in US, and several other OECD countries, plus integration challenges. But nevertheless, we see European Union representing almost 13% of new additions coming online over the medium term. This is basically due to remaining policies in some European countries and then a big push towards decarbonization of the power sector. And US, despite all the uncertainties of the tax policy and several discussions related to policies which are implemented at the state level, we see US representing around 9%. Japan, after the Fukushima accident, we basically saw that Japan needed new capacity, and it basically pushed solar PV capacity with oil and LNG to basically make up for the loss of power coming from nuclear power plants. However, Japan's situation is a question mark because we don't know how this nuclear development will happen over the medium term, but we still see Japan representing 5% of new additions and rest of OECD representing around 8%. Obviously, in this picture, there is one undisputable leader of renewable growth, is basically China, which represents around 40% of new additions coming online over the medium term. China has a big decarbonization plan, which is currently implemented, and then which is supported by relatively high feed-in tariffs for onshore wind and solar PV, and there is a big development in hydropower. So we see China basically by far the largest market. However, there are uncertainties that I will talk about later in my presentation. In addition to that, we see other non-OECD countries, especially India, Brazil, growing very fast. Basically, renewables in these countries meet the new demand that these countries need over the medium term. This is a different trend than OECD countries where renewables are not meeting new demand because there is no new demand almost. Renewables are basically displacing other capacity. In these countries, in non-OECD countries, we see that renewables are actually contributing to new energy needs. I'll explain that later for several particular regions. And India and Brazil together represent around 15% of the growth. And then another very important point is the rest of non-OECD. This basically shows what Mike was explaining, that actually the renewables are spreading over to different geographies. This is a new phenomenon that we see. As costs decreasing, renewables are deployed in many more countries, especially in rest of non-OECD countries. It represents as much capacity as European Union over the medium term for the projects coming online. Let's look at the closer look to the US. So as you can see, US capacity is a little bit bumpy coming online over the medium term. If you look at the story of the US, it's a familiar story if you look at the history of renewable deployment in the US. There are basically three drivers of US renewable energy growth. First one is federal tax policies, namely PTC and ITC, production tax credit and investment tax credit for solar and wind and several other technologies. The second policy is RPS, Renewable Portfolio Standards. And the third policy, state-level policies that are other state-level policies that are used to promote particular technologies in particular segments, namely residential and commercial solar PV. However, there's a big uncertainty on three of the policies. There are questions of basically at the federal level, big uncertainty over the extension of the production and investment tax credit, if it's going to happen. There's a discussion. For the sake of the information, I would like to inform you that this forecast is based that all the federal tax incentives are basically coming to an end. For PTC, it's coming to an end. For ITC, it goes down to 10% for utility scale projects for solar PV. That's why you see the same story that has happened in 2013. We expect the same decrease in capacity additions in 2016. And afterwards, we see slightly increasing renewable deployment, mainly due to cost improvements over the medium term. On the state level, there are discussions of the RPS. While some states decided to increase their RPS, like California, there are questions in other states like Ohio decreasing their RPS level. So it's kind of a mixed picture at the state level. On the other hand, the other policies supporting residential and commercial PV, we see mixed policies as well. Some states are pushing, like California and New York. We see other states questioning the deployment of distributed solar PV over the medium term. So there are two stories in this chart when we look at a little bit focus on wind in the US. I would like you to focus first on the left chart. It basically explains where US stands in terms of system costs for onshore wind. Actually, US is in a very, very good position. If we take China and India, where we see the lowest cost possible for wind systems, we see US actually lower than Germany and way more lower than Japan. And we see US cost going further down with actually commodity prices are at their lowest level right now. And then more improvements in basically technology manufacturing. US has one of the lowest costs because it's a competitive market first. Second one, it has a great manufacturing industry. Most of the turbines that are installed in the US are actually produced in the US. And we also see large-scale projects coming online in the US, which doesn't exist in some countries like France. You can see 100 megawatts or 200 megawatts projects can come online in the interior region of Turkey, which actually explains the economies of scale of the system cost. On the other hand, of course, when you look at today gas prices, it is very difficult to argue that onshore wind is basically perfectly competitive with natural gas generation. The graph on the right gives you a picture of 2015 and 2020 cost improvements on wind and expected but very uncertain situation of the increasing gas prices. So you see that the bars on the gas generation increasing is basically a little bit hypothetical because no one knows what's going to happen to gas prices, although many will argue that they will increase. So if we look at 2020 and wind generation at 50% capacity factors, which actually is already happening in the US in several windy areas, we might see not fully competitiveness, but more comparability, I will say. So in addition to the hedge value that Mike mentioned in his presentation, maybe we can have other values like more comparability, and in some particular places, wind can be the preferred option over gas over the medium term. However, one very big caveat that the uncertainty over the gas prices. When we look at the solar PV deployment in the US, I'd like to start with the utility scale. US already prone to be one of the lowest PPA contracts in utility scale solar PV. In the latest projects that signed PPAs in Nevada, 100 megawatts and 120 megawatts, they had one of the lowest prices that we showed on the map. So on the utility scale, US is doing very well. And our forecast shows that 2/3 of US solar PV capacity will come from actually large-scale utility scale projects. However, US holds a great potential on the distributed level, especially for residential and commercial PV. So when we look at the distributed level, we see that different than onshore wind costs, system costs in the US on residential and commercial level are actually higher than world averages. The reason why is that we see modules or panels only consisting of around 30% of the overall solar PV costs. So you see other 70%, which we call soft costs, which are high in the US. You have labor, you have permitting, you have financing, you have leasing costs, you have transaction costs. All these are still high in the US. This is maybe today not a good news, but it also shows you in the future that some of the costs can be actually decreased significantly. So in the US. And we basically expect these costs to be decreased with the cost reduction improvements and US distributed solar PV capacity to basically have a robust growth as well. So when we look at the overall picture of the US forecast, this is cumulative annual additions starting from 2015 to 2020. We see that majority of the growth in the US is coming from two major technologies, namely solar PV and onshore wind. The other technologies unfortunately contribute less because of various technology-specific barriers right now, which we can discuss later on. And we see the impact of federal tax policy creating this, I will say, US performing less than its potential. And the red bar that you can see is showing our accelerated case, which we talk about in the US case, what can happen if those challenges are met that I mentioned, which means further reductions in costs, further reductions in barriers in the distributed level PV, and more certainty over the long-term policy signals. One note on clean power plan, which probably most of you are wondering how it plays in our forecast. It has a limited impact because the current plan is states to be scheduled to submit their proposals by 2016. There's an extension up to 2018, and then the program will probably start in 2019, 2020. So if we look at from 2015 to 2020 for our forecast, it has a limited impact. And I will also say that we don't know if there will be legal challenges. That's a big question mark, obviously. I want to take you to some other geographies that we think are very important in our forecast. First, China. I will call the undisputable leader of renewable growth. So two technologies drive China's growth. We see hydropower. I didn't show hydropower because hydropower capacity is significant in China, but the additions we see decreasing because of environmental reasons, social reasons, and economic sites being not as available as before. However, I would like to take a look at onshore wind and solar PV deployment. By 2020, we expect China to install more than 30% of all wind turbines globally operating. So this is a big information, which means that our forecast goes, onshore wind forecast goes up to 600 gigawatts. 200 gigawatts will be installed in China. For solar PV, the jump is even higher. As you can see, in 2014, we are about 30 gigawatts of capacity, and it's going up to 110 in 2020, and with an accelerated case, it can go even further. In China's case, the main challenge is grid integration. China's grid is weak, although there's a lot of development going on in terms of enhancing grid infrastructure. However, both solar PV and onshore wind, there are plants that are installed and not connected. The curtailment levels of the power basically increased again in first half of 2015 up to 17%, which is a significant curtailment, which means that the money is basically, the power cannot be dispatched. And distributed PV is also a big uncertainty in China because of financing barriers and basically regulatory environment around it. However, we see China, again, being the leader of the growth. Let's take a look at good old Europe. So Europe basically was the leader of the renewable energy, and it actually contributed significantly on the cost reductions of solar PV and onshore wind. Basically, big innovators and big trial periods was in Europe. However, as you can see in the graph, this graph shows annual additions. Europe annual additions are decreasing because of sluggish economic growth, but also uncertainty over long-term policy signals. As an example, I will give UK, who basically are discussing to basically stop all the incentives to onshore wind, and also the governance around 2030 targets in the European Union, which were introduced last year. But there is a big uncertainty over who is going to govern and check if countries are actually implementing those targets. And there's one technology that Europe will do very well, is offshore wind. So we see offshore wind capacity increasing significantly in European Union. And I will say that probably offshore wind will again innovate and find a way to decrease significantly the costs for offshore wind. And probably after 2020, we will see offshore wind deployment basically spreading geographically. One important note on Africa. So Africa is very important continent for renewable energy because it has great resource potential, both on PV and wind. hydropower has already been an important part of Africa's power mix. However, we see for the first time initial signals that Africa can leapfrog like it did in landlines versus mobile phones. We are seeing the first signals that actually maybe renewables can power Africa's economic growth. This is a very important message. In this chart, you see how Africa's demand is growing and how renewables are contributing to this demand. The demand growth going forward, we see more than 50% of capacity or generation, renewable generation, covering Africa's demand growth. This is different than the picture in between 2008 and 2014, as you can see in the chart. And in 2020, our 2020 forecast is actually conservative. It doesn't take into account several large-scale plants that can actually come online. We put them in our accelerated case. So Africa is a different story, and it can actually be a good story related to economic growth versus renewables. So historically, renewables have been growing very fast. When you look at this chart, since 2006 to 2014, annual additions increased in a linear way, in some years in an exponential way. However, all this growth that we expect is actually showing a different picture, which I would like to emphasize. It's this. When you look at the additions going forward, we see a decrease a little bit over between 2015 and 2017, and then the additions are leveling off. The main reason behind this is very simple, is all the uncertainties that we see in several markets that I mentioned. Just briefly to repeat, US tax situation, integration issues in China. We see some of the goals are not met in India. We see some of the integration challenges as well in Latin America in terms of the grid infrastructure. Long-term policy signals missing in several places like European Union. However, there is a way to go forward in a different addition structure, which is this. Additions can actually grow in our accelerated case. In our accelerated case, we see renewable additions going forward actually growing, and which can put us on track with climate change goals that Mike mentioned previously. We need the growth that you see in that chart to basically have a chance to keep world in around 2 degrees scenario, I would say, on the renewable side, renewable electricity side. And in terms of investment structure, this is basically, we see in our main case, annual investment levels being around 230, 235 billion US dollars per year. In accelerated case, in 2020, we see this going over 315 billion US dollars, which is actually good signal and good amount of investment, because World Energy Outlook, our colleagues, say that in order to reach 2DS targets or long-term climate change goals, by 2030, the investment levels of renewables should reach around 400 USD billion a year. Accelerated case will put us on track. However, challenges, countries need to address challenges. One small note on connecting investment to the growth. So as renewables are becoming more and more competitive, and equipment to install those renewable plants are becoming cheaper and cheaper, we see financing costs becoming more and more important, which means that weighted average cost of capital, you can call discount rate, you can call share in equity and debt, cost of equity and debt. All this financial structure is actually becoming very, very important. And regulatory and administrative challenges has actually direct impact on these financing costs, because it increases the risk of renewable power deployment, and which is basically a capital-intensive technology. It's not like a gas plant. in renewables, you have to invest almost all your capital in advance, and the marginal cost of generation power is very low. However, in order to install all this capacity, either in both main case or accelerated case, you need money and you need lower financing costs to keep basically generation costs lower. As you can see in this chart, WACC means weighted average cost of capital, which means a combination of cost of equity, share of equity, cost of debt, and share of debt. And then you see how much two different structures play a role in terms of financing costs, and how lower WACC has actually increasing the cost of renewables significantly. And here, policymakers have a role to play, obviously, because the risks about renewables is basically, there are project risks, obviously. In some technologies, there are technology risks, but policy risks remain an important challenge for renewable deployment going forward. Just to finish, just to conclude with a few points. As Mike mentioned, and as we basically went through in all the slides, renewables are becoming more and more affordable, and it's growing all around the world, and it basically dominates new additions in the power system. Second, we see the impact of oil prices to be limited, especially on the electricity sector, because there is less head-to-head competition between oil and renewables in the electricity generation, first thing. However, obviously, the gas picture can change because it's still a little bit connected, oil and gas prices. However, in the heat and biofuel sectors, we see that the impact of low oil price can be more detrimental, or I will say they are more head-to-head competition. As I mentioned in the previous slide, the variability of renewable generation is actually a challenge in several countries, but is a challenge that can be addressed. Our other publications basically show that at the lower penetration or lower level of penetration levels, renewables are actually, it's not difficult to integrate. However, variability of policy risk, variability of policies is a risk which developers or investors cannot control. So if you change a policy, it has a direct impact on the balance sheet of a developer, which actually can have a harmful effect on the additions going forward. So accelerated growth of renewables, we see them meeting energy security, local pollution, and climate protection goals, and it is feasible, as we showed in accelerated case. One note on US. US remains a dynamic market despite all the challenges related to policy uncertainty on federal level and state level. And better growth could be achieved with better policy signals at the federal level and state level. Thank you very much.
You guys will join me at the table. We'll do a little Q&A. Just give us 1 second to get situated. No, that's fine. Yeah, thank you. If it doesn't have caffeine in it, it doesn't really help me very much.
Okay, I understand.
So thank you both. This is Travis Bradford. I am Director of the Energy and Environment Concentration here at SIPA at Columbia University and faculty affiliate for the Center on Global Energy Policy. As a reminder, I'm here with Michael Waldron and Heymi Bahar from the IEA talking about the Renewable Energy Medium-Term Market Report that came out this month, for which they are co-authors, and talking about kind of some of the profound changes that they mentioned. Also, as a reminder, I'd like any of you, either here in the audience or at home, to submit some questions that we can ask, and you would submit them, tweet them to @ColumbiaUEnergy, ColumbiaUEnergy, and use the hashtag CGEP, Center on Global Energy Policy Events, CGEP events, hashtag CGEP events. Anyway, so send those to us. We'll get to those quickly. Please, because one of the problems with following up a great presentation is they already answered all my questions. Although maybe I have a few hidden in my pocket here somewhere. So those, you really are talking about profound changes, and I guess sometimes for people who may not understand kind of the, changing the percentage of generation from 18 to 22 to 26% doesn't seem like a very big deal. They seem like small, mid-single-digit numbers, but clearly when you're talking about something with the momentum of the global energy system in terms of the aggregate amount of generation, that's a fairly substantial shift over, and when we only turn over about 2% of our infrastructure on an annual basis, seeing these kinds of changes are important. And I certainly think that the work that you all have done to emphasize the net new additions or gross additions on an annual basis is by far the best approach, because that's really what we have some control over. So I encourage everyone to look closely at both the aggregate and the marginal kind of investment numbers that are outlined in this report. So I need to go a little micro just to make sure I understand a couple of things on the micro level, and then I want to pull out and talk about what the implications of some of the things that you've mentioned. And we'll do it quickly because I know that there are going to be a lot of audience questions, but you have the base case in terms of renewable energy penetration and then the upside case. And you've talked about a number of drivers, but what do you really think, if there were 2 or 3 things that were the most critical, the key drivers of being able to get onto that accelerated pathway, what do you think those are?
I think the key driver is basically, like we discussed, renewables are very capital intensive assets. So the bankability of the investment has to do highly with the certainty and the investor has about his remuneration over the lifetime of the asset. So you really do need some sort of policy framework where you have a long-term price signal, and that policy framework is predictable and it's stable and it gives an adequate level of remuneration. And I think what's really interesting is that the costs of renewables have come down so much, in part due to deployment in countries with stable policy frameworks, that level of remuneration is actually becoming quite low. So it's much easier from a societal standpoint to add new renewables to the energy system at a manageable cost. But from resolving the uncertainty part, you really do need to have that long-term price signal, which gives some sort of certainty over the investment. And I think when you have that, combined with other things, so transparency in the way these things are awarded, access to independent power producers, which is still missing in a number of parts of the world, access to low-cost financing at a significant amount of volume, and also where you have markets where actually demand is growing. And so policy uncertainty is not as big of a factor as where demand is not growing and renewables are displacing the incumbents. I think when you have those factors together, these can have a significant impact on unlocking the accelerated case. But all of these things are very difficult to do, and I think it speaks to the notion of the way renewable markets are transforming. So basically, technology innovation and technology progress were a very big factor getting to where we are now. But going forward, I think regulatory progress and dealing with very tricky and sometimes not so sexy regulatory questions is actually very key for unlocking higher levels of renewable deployment. And in general, regulatory environments seem to move at a much slower pace than technology markets.
And we see this shift actually happening right now. And we see more countries introducing renewable energy auctions/tenders instead of feed-in tariff levels, which might be difficult to control over the medium term. We basically see countries such as many countries in Latin America where you see one of the lowest prices are actually happening because of they introduced a competition and the attractiveness of the market and the design of the competition has actually resulted in cheaper costs. And Europe is going towards that direction now as well. It started with feed-in tariffs, and now new state aid guidelines basically supporting more tenders and auctions to basically enhance competition and get costs lower.
It brings up a question about cost, and this is sort of an inside baseball geek kind of thing. But you do forecast that costs are going to come down, and how far and how
deeply some of those costs will change over time are an important component of future competitiveness and therefore uptake, presumably. How do you actually do cost forecasting over a medium term? That's a tricky problem, but what's your secret sauce?
I mean, well, it's not a secret sauce. It's actually a lot of data gathering, first of all. So we rely upon a lot of sources. I mean, I can get into the geeky details, basically, but the IEA has a lot of stakeholders, technology implementing agreements, who actually do a lot of technology-focused analysis and data collection, and we liaise with them a lot. We try to build a basis of what costs are in key markets, basically, so capital costs, by using our own technology network, but by looking at other sources, looking at government, looking at industry. We don't do this for every market in the world. It's impossible, but we try to address the key markets where we see deployment occurring, because this would reflect the cost picture overall. We have to combine this capital cost information with information on the resource availability, with things on operations and maintenance costs. And then increasingly, as Heymi has emphasized in his part of the presentation, is we need to understand the financing rates at which these things are being financed. And this is actually, I would say, the hardest part. And we try to rely upon publicly available data points or sort of indications that we get from those in the industry. But the financing costs can really vary quite widely according to different markets and different risk factors. So we put all this together, but we use a learning rate approach to assess what we think is going to be the improvements in capital costs. The other variables we basically keep fixed over the medium term. So we don't actually take into account if financing costs are actually improving over the medium term, which actually is a big factor behind the map I showed you. So this speaks to kind of the limitations of doing this on a modeling basis, particularly in technologies and in markets that are changing very fast, and we can't see all the underlying variables. Do you have anything to add?
And just one note on this, we basically look at the global, it's global and local learning. So we look at the global learning in each technology, and then we look at the local learning, which is actually also important. So that's one little detail.
I could spend an hour and a half just talking about that, but I will spare the audience the enjoyment. So, and just to confirm, just because different agencies do it differently, certainly in the U.S. even, but all of your investment dollars include distributed generation as well as utility scale generation. I just wanted to confirm that. Okay, so getting out of the micro and back into sort of the implications. Forecasts are generally, so you've got, what you did is you've got a baseline forecast and you've got an accelerated forecast, which I think is important. There are potentially, though, risks, downside risks. Are there things that you see that could happen that could actually cause us to fail to meet the forecast? Or where do the opposite question of what I asked about, what does it take to achieve the upside forecast? What would have to happen, or what might happen that would cause us to underperform relative to even the base case forecast? Okay,
I'll give you a few examples. I'm sure Heymi will have some as well, but maybe I'll start with something we haven't talked about as much. One of the reasons why our main case forecast is actually flat is because hydropower additions drop off quite dramatically. Hydropower expanded by about 40 gigawatts in 2014, and this goes down to about 20 by 2020, basically. So Heymi already spoke to the role of China. Hydropower had been hugely expanding in China, at least conventional hydropower, and now it's slowing quite dramatically because of social reasons, environmental reasons, the availability of economic sites. This is also occurring to some extent in India, so hydropower additions are slowing in India as well. I'm talking about large-scale hydropower, and also in Brazil as well. Brazil is related to the fact that in Latin America you have a drought right now, actually, and the role of hydropower and the diversification of the energy sector has become diversification has become more important for Brazil, which has typically relied on a high amount of hydropower. So these are projects with very long lead times. Hydropower, things like offshore wind, things like concentrated solar power. And so these projects oftentimes don't come on time. You have difficulties related to construction. You have difficulties related to financing. So these type of real-world factors, basically, just in terms of project development, can actually create the real downside for the forecast. And I would point to, again, the financing aspect as being crucial. There's a lot of projects out there. There's a lot of projects in the development pipeline, but in places particularly such as Africa, particularly such as developing Asia and Latin America, you just don't have the financing available. And so one of the first things I pointed out in one slide is we don't exactly know how a raise in U.S. interest rates and a raise in a more difficult financing environment will impact upon renewable financing globally. So I would point to that as being a major risk factor in terms of the downside. Not getting improvements in the financing that we've seen in recent years because of the policy environment, but also because of the macroeconomic environment.
And the forecast is basically a country-level forecast. So we go through technology by technology and country by country and look at the policy environment. Obviously, we spend more time on more important countries and less time for smaller economies. That's clear. But the forecast is a full bottom-up forecast. That's why we basically we think that we are realistic. But of course, we look at the project pipeline, and then some projects might not come online or might have some delays, and which can fall short of our forecast. However, I think it's quite robust in terms of looking at the very micro level and country level, and looking at the challenges, and to see how these challenges might have an impact on a specific technology over the medium term. This is what we do, and of course we can fail. But
there's one other interesting point I would bring up. I mean, this is more like a personal viewpoint, but I mean, there's this kind of, with forecasting, there's this kind of rest of world phenomenon where like people make these forecasts and then they say, okay, all this growth is going to come from rest of world, and they don't sort of really identify where that's going to come from. And we always have a hard time sort of saying, okay, you're going to get this dramatic scale up from 0 to something very big in rest of world. It could happen. For solar PV, it could very well happen. For onshore wind, it could very well happen because these things can be built rather quickly. But to go through one by one with those countries and to identify, okay, these are the countries where you're going to have this policy change where all of a sudden the sector becomes much more investable outside of the major markets, it's tough to anticipate those sort of changes. So this speaks to the limitations of what we do, but it also speaks to sort of the kind of realism in which we try to ground the numbers.
Yeah, I'm smiling because I certainly feel your pain in terms of that type of analytic process. So, so since both the upside and the downside case are so policy driven, and policy directly, but also indirectly through the risks that it creates and the impact that has on financing and the cost of financing, or access to finance and cost of finance. I want to. One of the big debates that we have right now in the U.S. In some quarters more than others is at this point, the ITC and the PTC, which you've shown are going to have a major impact when under their current termination in 2016, and they're going to have a fairly big impact in terms of drop off in the industry. And forecasting whether that's going to get renewed, or if it does, what it'll look like. Very difficult stuff. But the bigger question I've got is because these costs have come down, policy risks have not necessarily gone away because of the kind of open-closed nature of these policies. At this point, are these net beneficial policies or not to long-term growth and health of the industry?
to be honest, I think it is important to say things in advance. For instance, in the US case, it has been a long story of if it's going to be renewed or not renewed. I mean, I think the important keyword is certainty. Because if you give certainty to an industry, they will actually understand, okay, PTC and ITC is over, and then we have to look at this in a different perspective. But they can't do this. In a conference last May, when you talk about wind manufacturers in the US, some of them will say, oh, it will be renewed. Some of them will say it won't be renewed. So you cannot actually have a strategy. That's the main problem. And I think giving a certain and long-term policy signal for renewables, it's very, very important. And why we are talking about these long-term frameworks? Because renewables are actually different than fossil fuel or, let's say, conventional generation. They need a different market structure. They are not running on marginal cost. They are running on zero marginal cost. And the markets that we are in right now are designed based on marginal cost generation. So how can we actually design a policy framework that will give a long-term signal to both renewables and conventional generation so that they can coexist in a market? That's the biggest question. You need short-term signals, which is marginal cost signals, obviously, but at the same time, you need
kind of a long-term signals for capital-intensive renewables. So this is the question mark I think the policy makers or regulatory agencies should address over the medium term.
Yeah. And we're not saying that policy should mitigate all risks for renewable projects. I mean, renewable investments still need to be exposed to certain risks, basically, to drive them further towards cost reductions, basically. And I think we wrote in the book that basically saying it's much better to give visibility over, let's say, a 5-year extension or a 5-year timeline for the production tax credit, where it's going to go from here to 0 and then get rid of it forever, than to have this up and down, basically.
Well, that might be a good question. I was just going to mention we're about to start taking questions. I've got one more, but if you'd like to either tweet us at Columbia U Energy, hashtag CGEP events, and or join us at the microphone. But my last question before we get to that is really the question of when this transformation, this profound shift that we've seen, or what, under what conditions we shift, and you were starting to allude to this, Michael, just a moment ago. When do we actually shift to this being away from being effectively policy constrained or policy driven into one in which it is the the first best market solution, where we have established market economics and mechanisms that will allow those technologies that are the cheapest way to meet our reliable power needs or reliable energy needs to do so sort of outside of the constraints that the policy regime currently presents.
Mm-hmm. I mean, I think you need to look at it from the standpoint of having a transformed system, basically a transformed energy system, where, and maybe we sound like a broken record, but I mean, this is kind of the sort of crux of what we're getting at, basically. I mean, you still do need some sort of market rules, basically, which give the availability of some long-term price signals, some long-term contracts for renewables, given the capital intensity of the technology. So in a way, policies are always important, but it's a question of what's the level that you need to set the policies at, or set the policy support at, and how do the policies interact with the other parts of the energy system? So how do the policies provide the right signals so that you can increase the value of renewables? As you have more renewables in the electricity system, because they're low marginal cost, their value tends to go down, so they tend to cannibalize their own market. But yet they're providing benefits in terms of lower overall wholesale prices. They're providing benefits in terms of decarbonization and diversification, which are not necessarily captured by the price signals in a wholesale market. So, and we don't have the answers. It's a stream of work that the IEA is working on, and a lot of people around the world and a lot of policymakers are working on, is that how do you set up a market framework which gives the right long-term signals for renewables, but also the right signals for investments in the enablers of renewables. So to improve the flexibility of the power system, so to have dispatchable generation, to have more transmission and interconnection to expand balancing areas, to have demand-side response and storage also being able to play in markets and being able to get the right price signals they need, so that investment is made in these technologies, which in a sense, you don't need as much technology development, you need just the right price signals provided by regulations. So in a way, policy always plays a role. It's just a matter of what is the cost to society. And if you have the policies designed right, as is shown in, for example, Brazil, if you're awarding renewables under a price competition mechanism for long-term contracts, the price of renewables is actually low, or the price of onshore wind is actually lower than that from natural gas. But it's the way that the remuneration is structured has a big impact over whether that occurs or not.
Yeah, I guess it's sort of a pet question of mine, is how can you imagine a situation in which, because long-term price certainty is really helpful, but if the but that's not the way most of the sort of regulatory jurisdictions have gone, certainly in the industrial world over the last 20 to 25 years in the period of deregulation. So if is it possible to actually create a system where we can have short-term fluctuating market prices for kind of the incumbent generators and long-term power purchase agreements, whether they're under RPSs or feed-in tariffs or some other, or even straight direct customer contracts in the case of, say, a distributed generation system. Is it possible to coexist in a world where half the generation or some portion of the generation is on sort of is merchant and the rest is under long-term fixed price contracts?
Yes.
Yes.
It
okay,
is,
good.
It is
all right,
possible.
Next question.
It is possible. It is actually implemented in several places here in the US as well, in some parts in ERCOT and PJM. There you have nodal pricing, and at the same time you have PPAs signed. But there's a new, Brazil is a good example. Brazil has a short-term balancing market with a long-term contracts, which are basically centrally managed. We have another example. But there's a new country coming up right now, Mexico. They are changing.
I think Mexico's not new. It's been around for a while.
No, I mean new market reform is coming online in Mexico. Let's say new market for this new design. And Mexico is basically designed, is currently designing an electricity market with green certificates, which are auctioned for the long term, and at the same time a short-term market. So which means, like, think about a feed-in tariff, but in the form of green certificates, which is actually traded short-term and had a long-term auction as well for green certificates. So this kind of a hybrid approach is happening, and I think it will be basically the solution for the future. It will take time. I mean, when we designed all these markets, I don't know how many years ago, there were problems in basically how the economic signals or price signals were designed, and we basically corrected them over time. However, we are in a new world where those markets are not working very well in several places. So there needs to be a new market, and I think over time we will fix that problem as well.
The question we have to ask, I mean, from a societal standpoint, is do we want a flexible, decarbonized energy system or not, basically? And what are the sort of conditions that you need to get there, given the sort of capital structures and given the factors that we've talked about here? So I think if you look at the objective, where we want to go, that kind of informs sort of what we need to do to get there. And in that regard, yeah, we do think it's possible. But
Let's see December.
Difficult.
So yeah, I knew. So I promised we get to the meta. But there's so join us at the microphone if you have questions, and continue to send them to us on Twitter. But one question from Brittany Salas on Twitter asks, how can policy help develop low-cost financing for renewables in developing countries? I mean, so specifically, how do we address what kind of policies can be most supportive for precisely driving down the cost of capital and access to capital in these regions?
I think there's a couple things. One, we alluded to it, but the availability of limited public funds for concessional financing, so basically offering sort of loans or financing at attractive rates relative to the market. Even having a limited availability of that at a certain stage of the project, so for example at the construction stage, can go a long way to de-risking the entire project, basically. Another aspect is in many developing countries you have risks related to payment, so the credibility of the off-takers. So having some sort of de-risking mechanisms that basically give some sort of guarantees in terms of payments, particularly related to the off-takers, is another way, and also just loan guarantees in general have been effective. So I think these are a couple mechanisms. These are a couple mechanisms that can be done at very low cost to public bodies, but nevertheless, they're not being offered on the scale that would need to be offered in a place like Africa to actually make a huge amount of difference. And of course, this needs to be accompanied, of course, by significant reforms at the country level to open up access to independent power producers, to, in many cases, reform the power system, so to improve the financial sustainability of the power system. And this comes back to something that the IEA talks a lot about, is removing subsidies. So removing fossil fuel subsidies, but also in terms of you need to make power tariffs in many countries more cost reflective so that state distribution companies can recover their costs and can be more financially healthy. This is a key to reducing risk for the renewable projects, because in the end, these are the ones who are paying out, who are making the payments to the projects.
And let's remind ourselves that this is a new industry still. I mean, renewables are around for a while, have been around for a while, but it's a new industry. It will take some time for banks to basically understand and evaluate the risk of these projects. And it's been the case. 15 years ago, in some emerging markets or in even some developed markets, the financing was limited to renewables because banks thought that these are risky projects. Now this has changed, and I think the same trend with some policy improvements can happen in Africa and developing world.
That's great. Please introduce yourself and ask your question.
Good morning. My name is Andrew Isle. I'm an independent consultant, and I wanted to thank you, first of all, for your presentation for this report. My question centers on the potential variability around your projections for 2020, what the key factors are. And we've talked a lot about policy, how that's a key driver, and that really informs the accelerated scenario. You've talked about the role of financing and how that's mainly a potential downside risk, although perhaps not as quantified in your projections. The third factor, as I've understood it, is the price of technology and fuels in the marketplace. And I wanted to hone in on that a little bit and ask you if you, in your projections, have done sensitivity analysis for a much higher gas price, for example, or dramatically lower renewable technology prices than are anticipated, given what we've seen with solar PV, with gas, with oil over the last 5 years. I think assumptions really should be taken with a grain of salt. I'm wondering how that impacts your projections. Thank you.
Well, the answer is very short. No, we haven't done that. I mean, so this report has evolved over the course of several years. We're trying to introduce more sensitivities to it as we go, and the sensitivities that you raise are very important, actually, and I think they're things we need to increasingly address going forward in conjunction with the other IEA medium-term reports. So, yeah, in terms of our main case, we have a certain set of fossil fuel price assumptions, and we don't vary these in the accelerated case. The accelerated case is more based on policy changes rather than changes on the technology front. But you're right, of course, costs can change much more differently than we think. One thing I believe that we need to pay more attention to is the cost of battery storage and how that could possibly impact the feasibility of having more distributed solar PV. But still, a lot of the sensitivity of our analysis revolves around the policy rather than these other aspects. But no, it's an ever-expanding project, and I think we'll get there. We'll get closer to there as we evolve in terms of our analysis.
Excellent. Thank you. Any more questions? Just to throw in the moderator's 2 cents worth, you know, I think the trick with a lot of this is trying to figure out what's the binding constraint in terms of deployment, and if the argument is that it really is policy, whether that's and policy divides into those that need to change to the economics either directly or through the cost of finance, versus those that just enable market access, as you guys have defined it. If it's market access that's the problem, making it cheaper isn't necessarily going to, or making the competition more expensive isn't necessarily going to relieve the binding constraint. So I think you guys have focused on that for the right reasons, which is there are just a lot of places where we aren't actually seeing the proper price signals in the first place, much less before we need to improve those price signals. So one final question, because this is a medium-term market report, and you've articulated a way that we can get to by 2025 with an accelerated scenario, gets us to a slightly higher baseline, some additional growth, some additional improvements in relative economics and market access that we can get to. Renewables can do its fair share of meeting the 2 degrees C scenario. There's some question as to what the other sectors are going to do and whether renewables might have to do more than its fair share to meet the overall goals. But leaving that aside for a moment, you know, what you're essentially talking about is in effect bending the curve on climate and carbon emissions and kind of the climate problem, at least from the point of view of this very large and important subsector of that. My concern is as you're looking out beyond the medium term, you know, and it almost seems like going, you know, 5 years or 10 years ago, we thought, you know, even increasing the penetration of renewables was a pretty heavy lift, and today we're arguing about whether we can get it to 32 or 36%. You know, maybe we're not quite doing enough. This is a big move in the right direction. It may turn out that getting, you know, from 18 to 36% was the easy part. It may turn out that beyond 2025, getting it to higher and higher levels of penetration, not only bending the carbon emissions curve, but driving it back down to zero. You know, sort of turning it so much that the momentum drives us to, you know, a truly sustainable carbon emission and balance scenario. Do you see longer-term problems that we should start to address today to enable the renewables to not only bend the curve, but eventually achieve the outcomes that we need?
That's a really big question.
Well, yeah, it's the last question.
So I'm sure we'll both have thoughts on it. So maybe I'll give just a couple points that I thought of. So basically, to bend the curve in the power sector, you need renewables or some low carbon technology needs to displace coal. So coal needs to go out of the system, basically, particularly the most oldest and inefficient plants right now, but in general, coal has to be pushed out in a major way to meet decarbonization goals. So in places where renewables are starting to go head-to-head with coal, not necessarily in terms of competition, but just in terms of, you know, the institutional framework. And we're seeing this in China now, with China trying to have, at least in practice, green priority dispatch for renewables. And this creates a lot of institutional problems with, okay, kicking coal out of the system. This relates also to the other sectors, which we haven't talked about so much, the heat and transport sectors. Because the heating sector actually represents almost 50% of total final energy consumption. So it's kind of the elephant in the room, which is not addressed as much on the policy side, but also in terms of our analysis, we don't address it as much because it's just a much more difficult sector to analyze. In some cases, you have coal in China running because at a certain amount of hours per year to satisfy heating needs, to feed into the district heating network. And heating is actually a more sensitive social and political issue than electricity. So you need to find ways so that low carbon electricity sources can also start to participate in the heating sector, which again requires the right price signals and the right infrastructure. But I think it's the linkages. When you start to see these linkages between sectors where low carbon electricity is starting to help out in terms of decarbonizing the heating and the transport sector, these are the really sort of big things you need in the long term to change the curve like you're describing. But that requires a level of flexibility in the energy system, which in many cases doesn't exist, and requires a whole rethink of the way assets are priced and remunerated and regulations treat them. And maybe you can add something.
Maybe from a little bit of macro level, IEA just released a report yesterday, 2 days ago, on analysis before the COP21 meeting. And the analysis shows something very, very simple. The INDCs, intended national...
We'll just go with INDCs.
Yes, INDC. Let's go with INDC. So INDCs,
it took me a long time just to remember that.
So INDCs that are submitted, which like I think 90% of economic activity, countries representing 90% of the economy, and also 90% of the carbon emissions submitted their INDCs. And the report shows that if those INDCs are met, we will see the temperature decrease to be around 2.7. So temperature increase, not decrease, obviously, 2.7. So it's not on track, definitely. I mean, there's no, even with all this effort that preparing INDCs is not on track. But at a macro level, I will say, this is my personal opinion, that it is important what will come out from the COP. If those INDCs will be binding or non-binding, I mean, we have seen bilateral efforts between China and US and India, then afterwards joined. Several countries are talking about like further efforts and so on and so forth. I think there's a more positive outlook towards COP21, at least I have personally. However, I think the macro level policy signals might change several things. And if it happens in December in COP, maybe countries, a decision, we don't know what can be decided, there are a lot of scenarios, but a good decision might actually give right signals going towards a 2-degree scenario. I think that's very important.
Well, I think we have to end on that optimistic note. What I do want to thank both of you, not only for your time today, but for all the work that you put into making this information available and telling the story and giving people the tools they need to engage in this sector, because I think it's just incredibly valuable to lots and lots of people. So if you'll help me thank them for their time and their work.